Hello, I'm Mansoor Mohyuddin, and this is Bank of Singapore Research. 10-year US Treasury yields have surged to 16-year highs around 4.7%, challenging financial markets across the globe. First, the Federal Reserve remains hawkish, warning it may still need to increase its Fed funds rate further this year from its current level of 5.25% to 5.5% to curb inflation. Second, the US economy remains surprisingly resilient despite the Fed's rate hikes. Third, oil prices have increased sharply to almost $100 a barrel. Fourth, the looming US government shutdown and the earlier US debt ceiling impasse have caused the major rating agencies to either downgrade or warn about the outlook for US Treasuries. And last, decisions by the Bank of Japan and the European Central Bank to tighten monetary policy have helped push up government bond yields globally. Over the next few months, Treasury yields are set to remain volatile. We don't expect the Fed will raise interest rates anymore, but the risk is likely to keep yields elevated in the near term. Yields may also stay high until the US economy slows more. We had expected the Fed's rate hikes would lead to recession in the second half of 2023. But the economy seems unlikely to contract this year now. We thus expect 10-year Treasury yields will now remain above 4% over the next 3 months. But a US recession may only have been delayed rather than averted. America's GDP growth is set to slow in the fourth quarter of this year due to the potential government shutdowns, strikes at car firms, and a moratorium on student loan repayments ending. During the first half of 2024, we expect slowing growth will give way to an outright downturn as consumer pandemic savings run out, the government's larger budget deficit starts to fall, and tighter financial conditions curb borrowing. We thus keep our 12-month forecast that 10-year yields will fall back to 3.25% as the US likely enters recession next year. Investors should therefore maintain a cautious stance while the economic outlook remains uncertain. For more information, please refer to our monthly investment guide titled The Delicate Balance.